Yo, what's up guys? Welcome back to the channel. It's Nate the Robber here, and I actually just made a huge change to my Robinhood portfolio. I completely sold out of one stock on here, and I actually bought three new stocks, three dividend paying stocks. I can't wait to share it with you guys, and I think all of you are going to love the move because I got a lot of criticism like, yo, dude, I think you're not diversified enough, and to those people, you're exactly right. So I decided to make a huge change. But of course, like if we go over here to my Mumu portfolio, I'm never allowed to make a change in here because this is my portfolio where once I buy a stock in here, I'm never going to sell it. But as we can see, we got some stocks like Perion Network down 51%. And Bill Holdings, they actually reported earnings yesterday. And look at the spike. It like went up initially, then it went back down. So the markets need to digest their earnings a little bit more. But anyway, let's go back to the Robinhood portfolio where I just made a massive change. So I completely sold out of ticker symbol POWL, and I bought some of the most proven best companies in the entire world, some of the Magnificent Seven. So I bought shares of Meta. So we got Meta stock right here. I bought 2 shares, and I'm probably going to buy one more share with my extra money. But I also bought Salesforce, ticker symbol CRM. They are a dividend paying stock. It doesn't really matter how much I'm up or down on it. And we also bought Google stock. So I said dividend stocks. All of these stocks just started paying dividends, and they all have yields very close to 0.5%. So even though all of these stocks don't really have super high dividend yields, like around 0.5% each, I have some other stocks that make up for that, like Public Storage. They're a real estate investment trust, and they have a dividend yield of almost 5%. And American Financial Group, which has a huge history of paying out special dividends, and they also reported earnings yesterday. They were really good earnings in my opinion. But yeah, this is the stock I completely sold out of. You can probably guess why I sold out of it. I was up like crazy on my shares. I well over doubled my money. I sold most of my shares for like 115% gain. But I've been watching this stock for so long. We had this wedge right here. Let me know, do you guys believe in technical analysis? We had 2 wedges down here, and or I don't even know what it's called, like a triangle, descending triangle. I don't know, but point is, I completely sold out of this stock because it was my largest holding by far, and the market cap is really tiny. I just wanted to de-risk my portfolio. But yeah, now I want to show you why I chose to put my money in stocks like Meta, like Salesforce, and Google. But look at Meta right now. They're trading at a forward PE ratio of 22.48. So that's actually really fair. And the dividend yield, because they now pay a dividend, is 0.44%. So that's actually really attractive. I'm telling you right now, I would not buy Meta, Google, or Salesforce if they did not pay a dividend. This is a really good sign. I think now that they pay a dividend, they're going to be a lot more smart with their money, be more financially disciplined. So check out their free cash flow per share growth. Like I'm showing you the Magnificent Seven numbers. Like obviously this is going to look amazing because of how the stock's been doing, but it's still a fair valuation in my opinion. But look at the free cash flow per share growth. Now take 4 quarters of this. You get the annual free cash flow per share and do a multiple on that. The stock is really cheap in my opinion, and that's just the free cash flow per share. Here's the net income. This is the EPS growth. And obviously, if we go on an EPS multiple, it's trading at a 25 trailing 12 months PE, but a 22 forward PE ratio. It's a super good deal in my opinion. But let me show you Salesforce. Now this stock, it's going to look expensive because look, the PE trailing 12 months is 65. But their EPS is projected to grow well over 30% over the coming years. So that's why the PE forward ratio is still 28, but it's actually cheaper than that if we even go out to 2026 estimated numbers. But here's why Salesforce is super impressive. Obviously, I like their products and services like Slack. Slack is a really big one, but look at the EPS growth. They can just choose to have these EPS returns. Like, this is crazy, and that's the net income. Like, look at how much they can grow their net income, and that's just their net income. Let's go to free cash flow per share, and how much is their dividend? So their dividend is 40 cents a quarter, and that makes a dividend yield of 0.58%. That's pretty juicy for a stock that just started paying dividends for the first time ever. That'll obviously grow their dividend. But look, their free cash flow per share has just, the green numbers are the year-over-year numbers, and Salesforce, I love them. Do a multiple on that. And the last one we got to go over is Google. They fell today. And oh yeah, I own 1 share of this in my Webull account. Again, not much, but I have no problem buying Google at all-time high. So their dividend yield is 0.48%. And the PE forward ratio, again, it's fair. It's 25. It's a 24.65. And their EPS, their net income is actually up 60% year over year. And who doesn't love Google? I love all their products. They're free like YouTube. You're watching this on YouTube right now. Hey, don't forget to drop a like on the video. It really would help me out a lot. And subscribe if you like how I break down the numbers. But Google, for obvious reasons, even though it's an all-time, I sold my original shares to buy this company. I sold my stock for a double. So technically, I'm like, I could lose 50% on Google, and I'd still prefer that than owning the other stock. That probably didn't make much sense, but I love Google, man. But yeah, this is the stock I completely sold out of, and they actually reported very solid earnings. Look at this EPS growth, up 293%. So if we look at their PE ratio, even though this stock is like at the all-time high, their PE trailing 12 months is at an 18. They're trading at an 18 times PE multiple. But the PE forward ratio is actually at a 20. So what that means, when the PE forward ratio is higher, that actually means they're projected to slow earnings, and earnings are supposed to be negative year over year. So I think that might be the reason for why the stock is kind of selling off. I don't know. But anyway, guys, I just wanted to show you, I'm actually super happy owning Google, Salesforce, and Meta. I can sleep well at night knowing nothing bad's going to happen to them. And obviously, I love my stock like Carlisle. This one is also trading at a PE ratio of 25. So this stock is actually, Carlisle on a PE ratio is more expensive than Meta, Salesforce, and Google, I'm pretty sure. Oh no, not than Salesforce, because Salesforce is projected to grow so much. That's why we should look at Salesforce's price to earnings growth ratio. Should we do that right now? So let's actually do this. It's my favorite website. So yeah, look at this. This is Salesforce, which PE ratio is at a 65. But look at this. The EPS growth is projected to grow 30% over the 5 years. And that's why if we go to the PEG ratio, the price to earnings growth is literally at a 1.58. And if you don't know what that is, it actually it's the expected growth. Anyway, hope you guys have a great rest of your day. If you leave a comment, I'll respond to every single one of them. But hope you guys have a great rest of your day. My name is Nate the Rob.